Hi everyone, I'm Alice Yu from S&P Commodity Insights. I'm responsible for publishing market and price forecasts for lithium and cobalt delivered through the S&P Capital IQ Pro platform. Now, battery metals have suffered from demand headwinds, but pipeline development, especially in lithium, remains red hot. Now, why is this the case? We'll find out in this presentation, together with the long-term rationale for other battery and critical metals, including nickel, copper, and cobalt. Okay. Now, the content shown today is hosted on the S&P Capital IQ Pro platform. Now, this page just gives a snapshot of the variety of data, insights, trends, and analysis available. The metals and mining team I am from work with that data to come up with forecasts across supply, demand, and prices, as well as mining financing, deal making, and discoveries and exploration trends. Now, this presentation will focus primarily on the battery metals, as lithium, cobalt, and nickel. I will also touch on copper, which is a key critical mineral needed for the energy transition from EVs to the energy infrastructure. Now, battery metals markets, lithium and cobalt markets, were hit by the slump in EV sales in the first quarter from policy changes, especially as central government subsidies were withdrawn in China and as incentives were cut across several European countries. Now, EV sales have since recovered. China still leads sales growth across top markets this year. 1 million more EVs were sold in the first 7 months in China than the same period last year. The US experienced the fastest sales growth rate, but from a much smaller base. In general, the car market in the West is benefiting from supply chain improvements, but affordability is increasingly becoming an issue. Driving the EV sales is lithium iron phosphate battery, LFP chemistry. LFP is the fastest growing chemistry among China's traction battery production. So lithium demand is better supported by LFPs at the expense of nickel and cobalt containing chemistries. There are very strong macroeconomic headwinds that has been biting into metals demand. The US dollar has continued strengthening on interest rate hikes by the US Federal Reserve. S&P Global Economics, that is S&P's in-house economics team, don't expect rate cuts before June 2024. And this higher financing cost has dented demand for goods and the need for manufacturing activities. Now, China's economic recovery has been really disappointing and rather unfulfilled. The country has finally stepped up its measures to shore up its economy this month. Some of the key measures include relaxed home purchase restrictions and lower mortgage rates for home buyers. And these policies provide some cushioning to the otherwise faltering economic recovery. And these policies give some respite to the country's troubled real estate sector. But we are unlikely to see very aggressive stimulus measures this year due to concerns about debt and financial risks. It also takes time to reestablish consumer confidence, to retain the sense of wealth, which is largely in properties, and to get consumers to spend again. So these headwinds have been pressuring metals prices. Take, for example, the lithium carbonate spot price. The price in August is 50% lower than the average in January. For cobalt, the price is also 50% in August than in January. For nickel and copper, the prices are 27% and 7% lower. Now, the long-term fundamentals for critical metals are still solid. Metals are needed in the energy transition, in EVs, in grid storage, in renewable generation, and in the electricity infrastructure. Now, long-term supply is really challenged by lengthy exploration work and the time it takes for mine development. It takes on average 15.7 years from discovery to production. And this means most mines that will be in production by mid-next decade are already known to us. But even by 2027, we expect market deficit to emerge for refined cobalt, for refined copper, and for lithium chemicals as demand growth outpaces that of supply. Now, deficit in the copper concentrate market will happen even before the deficit in refined copper. We expect the copper concentrate market to be in deficit from 2025, and this deficit will deepen from 179,000 tons to 2.2 million tons in 2030 in our base case scenario. Chile is expected to be the largest contributor to supply growth, but it has been hampered by various issues like low ore grades, technical problems, and water shortage. And there's also a downward trend in the rate and size of major copper discoveries over the past decades, despite higher copper prices. We update this discoveries data every year, and you can see that the discoveries were way higher in previous decades of the 90s and 2000s. And this drop in discoveries is due to miners and explorers focusing more on known deposits and producing mines. And the lack of discoveries really amplify the risk in the medium to long term that there won't be enough copper to meet demand growth. We track financing raised for a basket of commodities by junior and intermediate mining companies. And these are companies with annual revenue of less than $500 million. For major companies, they can rely on the cash generated to finance projects. But for the smaller, small to intermediate mining companies, they're more reliant on the market for financing. So this indicator showcases the level and trend in mining financing activities. Total funds raised in the first 7 months of this year are nearly 20% lower compared to the same period last year. And if we look further back, the funds raised this year were just half of the funds raised in the same period in 2021, when the supply chain was congested and metal prices were on the rise. Gold, copper, and nickel weighed down the total funds raised this year. But notably, lithium bucked the trend and experienced the largest dollar increase. Lithium fundraised is up 344 million in the first 7 months. And the largest fundraise in lithium this year have been directed towards development of assets in the US and in Canada, which has been encouraged by the Inflation Reduction Act. Cobalt has seen a smaller increase, but it is still in the growth territory. And that reflects the fact that more investments are needed, especially as the cobalt supply pipeline visibility slows from 2026, the same year when we expect a market deficit to emerge in cobalt. Now, out of the 4 metals discussed today, nickel is the only one which we expect to be well supplied into 2027. And that is because of the rise of Indonesian supply. We expect the share of Indonesia's primary nickel supply to rise from 25% in 2020 to 44% in 2027. And this supply increase really reflects the investments that have been made in commercializing laterite ore for use in battery and stainless steel. Despite a well-supplied short to medium term, nickel also faces a very similar issue as copper, that major nickel discoveries have been really insignificant for the past decade, and that will really be challenging for long-term supply pipeline. And this issue could be more problematic, especially as parts of the Indonesian government are calling for the conservation of its nickel reserves for more value-added products in EVs, which could be unfavorable for NPI production used in stainless steel. Now, geographical diversification of metal supply is playing an ever important role considering geopolitical tensions and as countries evaluate the sustainability and friendliness of their supply chain. On the whole, the battery metal supply chain is becoming more diversified. Africa and North America are playing a bigger role in lithium supply. Indonesia has overtaken Australia as the world's second largest cobalt producer, and that helps to reduce some of the supply dependence on Democratic Republic of Congo. But the DRC will still account for 66% of global mined cobalt supply in 2027. For battery cell manufacturing, Europe and North America will be home to more production capacity, chipping away at a dominant share of China. But for nickel, supply is actually becoming even more concentrated because of Indonesia, and there is really no way around that. There are some problems to this. So nickel production from Indonesia's laterite ore has a bigger carbon footprint, and a lot of that investment, the increase in supply, are tied to Chinese capital, or they serve and they are exported to China directly. So for nickel, the trend is in contrary to the angle Western policymakers are trying to drive, that is to diversify away from China. We expect metals prices to stay elevated to incentivize pipeline development, given the longer-term deficit. We already discussed that there has been a shortage of recent discoveries, especially in copper and nickel. So prices really need to stay high to encourage exploration and development. There could be greater competition for materials, which will benefit miners. And in some cases, there will be a premium for more ethical and greener material sources. So right now, metals prices are being affected by softer demand, weaker growth prospects, and poorer sentiment. And these price corrections could take some time to play out fully. But if we look over a longer-term horizon and compare the metals price forecast in 2027 against what they were in 2020, lithium prices are expected to be 3 times higher in 2027 at above $34,000 a ton. For cobalt, we expect the price to be 40% higher in 2027 compared to 2020 at $21.8 a pound. For copper, we expect the 3-month price to be 60% higher at $9,900. And for nickel, we expect the 3-month price to be nearly 50% higher in 2027 at $20,500. But these short-term demand challenges do not move the long-term story. In fact, the price drops highlight the volatile nature in some of the fastest growing battery metals markets. And downstream players and consumers can better shield cost volatility through having an accounting for battery metals at cost instead of at the market prices. Investors are acting and pricing in the long term, especially for lithium and cobalt. Actually, we have seen an increase in deal-making interest from lower valuations because prices have fallen. And in the way, the rise in Indonesian nickel supply shows the investments that has already been made in boosting the supply pipeline. But for copper, the investment isn't quite there yet. And as governments across the world strive to reach their net zero goals, there'll be greater need and competition for resources that will be in deficit. And that marks the end of my presentation. Thank you for the host for inviting me for this session.